This week, markets are nervous ahead of a big week of data and events. Hi everyone, welcome to the weekly market update. It is Tuesday the 9th of May 2023, and just before I get into it, you do need to be aware that anything I say is general advice only. It does not consider your personal financial circumstances, and you have to decide whether what I'm saying is appropriate for you. So the banks. The banks this week are basically coming out of their reporting. So we saw a report from NAB on Thursday that was not very well received and it fell strongly. We then saw ANZ and Macquarie on Friday. They were a bit better. They both jumped on their report. We had Westpac yesterday, and then we had the CommBank trading update today. Now each of these reports have been a bit mixed, but some of the key themes have been that net interest margins haven't been quite as good as many had hoped, and that perhaps some competition amongst the banks is forcing those margins lower. With NAB, they had a bit of a miss in total, but with CBA today, they actually met expectations, but they were a bit under pressure after those margins came down. Now, this should be a period where bank margins are extremely good, and if they're unable to maintain their margins, even during a time like this, well, we may have reached, peak margin for the banks. So that's a bit of an interesting story on the banks unfolding. I do think that, as long as our market holds, a bit of love will come back into them over the coming weeks. But if our market comes off, really, we could see them, languish at their lows and not return to their highs of a few months ago. And that is really a sign that, that their margins, their performance has been a bit worse than everyone was expecting. The next major thing we'll touch on is the Australian federal budget. So that's going to be announced tonight, and already you get the preface from the different members of Parliament, and a lot of the features they're expected to announce are already known. So one thing that we're probably going to see is an increase in the petroleum resource rent tax. It wasn't very much of an increase, and I think that the oil and gas stocks will probably be happy that it was only a very, very modest, very minor increase in that tax. And I think a lot of people think they should have gone a bit harder. Nevertheless, there could be some pressure on that space in the coming days, just after that tax is announced, just as there's some adjustments in the market, and also given the fact that oil and gas prices, at least on a commoditized basis, are very weak at the moment, trading around yearly lows. Some other features in the budget expected to be announced tonight are a $15 billion cost of living package. Now, this package is expected to include measures such as relief on energy bills for low and some middle income households, as well as some other measures. Some people have attacked the budget or attacked this announcement as saying that it's inflationary. However, I would like to note that this will almost certainly be the first surplus budget in 15 years. And just looking at the very headline numbers, a surplus budget takes money out of the economy, whereas a deficit budget puts money in the economy. So how can you attack this budget as being inflationary when it's the first budget in 15 years to take money out of the economy? So it'll be interesting to see what the market reaction is tomorrow. I don't think these prefaces about policy have had much impact on the market at all so far. And have a look at the different sectors tomorrow and perhaps try and draw some parallels between their movement and what was announced tonight. Moving on, we've got the other major event from this week, and that's the US CPI reading, which is going to be released on Wednesday night our time, in a little over 24 hours time. This CPI reading is huge. Most of the market has expected that the Federal Reserve has finished raising interest rates, that the raise they had at the start of this month was the last that they'll do, and that this will be the top of this tightening cycle. This will be peak interest rates for this tightening cycle. Now, this CPI data has the potential to disrupt that belief. And if it does disrupt that belief, I suspect we'll see strong selling in global equities. So most economists are predicting that CPI growth is going to stop coming down. It's going to come in line with April, and that the inflation, the slowing inflation, is going to basically stall. So if that's the case, I think markets really have to consider that more interest rate rises might come. If inflation is no longer falling, the Fed definitely will be looking at further rate rises. And if the market starts pricing that in, we could see some selling in equities. All right, so let's have a quick look at the charts and let's just see where both the Australian and US indices currently sit. So this is the Australian XJO index, the top 200 stocks on the Australian market. And we had that big recovery, that big bounce up from late March into April, but since mid-April we've been selling off. We've basically broken below the key levels around 7,300. We found some support last week around 7,400, but we were unable to break back above that previous support level. We held that as resistance yesterday. So for me, we're now in a bit of no man's land, and we're also just inside this giant potential pennant pattern that's forming. So our market probably in a bit of a holding pattern. I'd say we're waiting to see what the US does. We're waiting to see what the effect of the budget is. We're waiting for some of these banking dividends to come out of the market. But I do think there is a bit of risk to the downside here. There is a bit of risk to the downside, and I wouldn't be surprised to eventually see a move back towards the 200-day moving average and maybe 7,100, which is roughly where my longer-term uptrend line will sit. One of the reasons I say that is that US markets, one, they're looking a little bit toppy, and they also have some headwinds in the form of the approaching government debt ceiling. So in addition to that CPI reading, the US federal government is approaching their spending limits, and they're basically going to have to extend that debt ceiling. They've got all the tools and mechanisms to do so, but some sides of politics may view it as politically beneficial to not extend that debt ceiling. And I'm talking about the Republicans. They could be playing a bit of politics here and try and stop the Democrats from extending their spending limit to try and benefit them in the presidential election next year. If that's the case, and we do see a bit of a government shutdown in the US, I would expect US markets to come back off a bit. And they do look a bit toppy. They're holding around yearly highs, and that's despite further interest rate rises. That's despite their rapidly approaching debt ceiling. That's despite it was a fairly good earnings season, but that's despite forward earnings forecasts starting to look a bit more negative. And for me, I think there is again a bit of risk to the downside. So on the S&P 500. For me, the support's at 40.50. I think that's the first target. If that breaks, you've got 4,000 and then potentially 38.50 down here. If I'm wrong and they do rebound from here, perhaps after CPI on Wednesday comes in lower than expected, then I would expect them to rise with the first upside target around 4,200, and then if that breaks, maybe 4,300. That's it for this week, guys. Hopefully you've enjoyed. If you have, let us know in a comment down below. Click the like button, click the subscribe button. If you haven't enjoyed, do all of that anyway, and I'll see you in the next one. Bye for now.